Up on screen's a graph of the Dow Jones, and we can see in the last 5 trading sessions the US market sell-off's really starting to build in momentum. The risk to the market is that whilst the first stage of the sell-off's been triggered by bond yields rising, the reality is probably far more significant issues sit in the background, and that's the level of consumer debt as well as government debt that's going to weigh on the prospect of any rebound in the market. Any rally that we get back, that we have from an oversold level, I think will be short-lived, and I think there's further downside in the market. Let's just go through and have a quick look at the other indices here on the S&P 500. So we can see the sell-off there in the S&P. Actually, let's just jump back to the Dow and have a look at where the market's come from over the last, say, 12 months and from a longer term perspective. So from 2014 through to 2017, the market really consolidated around this 18,000 level. And then you've had the election of Trump, the tax cuts, synchronized global growth, and you've had this sort of parabolic extension in the Dow over the last 6 months. So to me, the first part of the stop-off's probably back down at around 2,200 points, but ultimately I think the Dow should be trading back at around 20,000 points, and whether that plays out over a 6-month period or whether we get there in 3 or 4 days, only time will tell. But from a valuation standpoint, PE perspective, where underlying earnings are, that's my perspective as to how far overvalued US equities are at the moment. Let's have a look at the S&P 500, then we'll have a quick look at the Nasdaq and the XJO. So the same with the S&P 500, the consolidation range was around 2,000 or 2,100 points. Then you've had the expansion from 21 up to 2,800. So first stop on the way back down should be around 2,400, but ultimately I can see the market consolidating between 21 and 2,400 as a fair range. In the Nasdaq, let's have a quick look at the Nasdaq here. This is the Nasdaq Composite. So same thing, consolidation range in 14, 15 and 16 was around sort of this 4,000 to 5,000 points. And we've had the big rally from sort of 5,000 up to 7,500. First stop off should be consolidation around 6,100, but ultimately the consolidation range ends up being between 5,000 and 6,000, I think, for the Nasdaq. The local market, the XJO, if those targets were to play out on the XJO, you'd have to say that the first stop-off's probably around 5,500 points, but ultimately consolidation's probably between 5,000 and 5,500. Let's have a quick look at the stocks that are moving within the top 50 today. So we're seeing Macquarie Bank give up ground. You're seeing the energy names. You're seeing Computershare, which I've spoken about that being a very high PE. To me, Computershare, only 18 months ago, the company had contracting earnings, and then suddenly the stock trades from $9 up to $17. I think this stock's grossly overvalued, and there are other examples within the top 50 stocks like that. High PE names like Aristocrat, Treasury Wines, James Hardie, building space, Ramsay Healthcare's under pressure just because as interest rates rise. But I think on Ramsay, quality businesses like that is where you want to look for the buying opportunities as this sell-off sort of spreads across all areas of the market. Medibank Private, keep an eye on that one. I think sort of sub $3, that's going to be a good buy. Let's have a look at what's holding up today. Newcrest, which was added to the model portfolio at the end of last year, is holding up reasonably well. So is Amcor, which is one I've been chatting about. I think AGL holds up okay in this sell-off. You're starting to see them reduce the probability of a fourth interest rate rise in the US. So already as US equities sell off, the bond market, albeit it was the trigger of the event, is actually starting to reprice the chances of 4 rate rises in the US. So these yield-sensitive names will find buying support probably ahead of other sectors in the market, and for that reason we'll continue to revisit the yield sensitive names in the morning reports. Moving down the list, you can see Sonic Healthcare is holding up okay. Sydney, Westfield, but yes, the selling's pretty heavy across the whole market at the moment, with most of the cyclical stocks down around 3%. So our strategy of cutting cyclical, cutting high PE names, and adding defensive positions to client portfolios through the B bus, which is the inverse ETF on the S&P 500. And if we have a look at how this is behaving, so we've started buying this at the end of last week, and we're now seeing that this has put on almost 20% now from when we bought it. Even from yesterday alone, when I commented on it on the blog, it was $5. So it's put on almost 10-12% overnight. We still see further upside in this, maybe back to around $6.50 before it runs into some resistance or selling pressure. So if you have a equity portfolio, even if you don't have an account with us and you'd like to just talk about the subscription to our service, so we can discuss with you the type of strategies we're running on portfolios, please give us a call, 1300 614 002. Thank you.